Welcome to Video 7. Today we cover conforming loans, the foundation of the conventional mortgage market. Fannie Mae, Freddie Mac, loan limits, PMI rules, underwriting standards, and the secondary market. This content appears throughout the General Mortgage Knowledge section of the NMLS exam. A conforming loan is a conventional mortgage that meets both Fannie Mae and Freddie Mac purchase guidelines. Two requirements must both be met. 1. The loan amount must be at or below the FHFA conforming loan limit, and 2. The underwriting must meet GSE standards for credit, DTI, LTV, and documentation. All conforming loans are conventional, but not all conventional loans are conforming. Jumbo loans are conventional but not conforming. The 2024 conforming loan limit for standard areas is $766,550 for a one-unit property. For high-cost areas, the limit is $1,149,825. The limit applies to the loan amount, not the purchase price. A $900,000 home with 20% down equals a $720,000 loan. That is conforming. A $700,000 home with 5% down equals a $665,000. Fannie Mae and Freddie Mac are the two government-sponsored enterprises that operate in the secondary market. Fannie Mae's automated underwriting system is called Desktop Underwriter, DU. Fannie's 3% down program is Home Ready. Freddie Mac's automated underwriting system is called Loan Product Advisor, LPA. Freddie's 3% down program is Home Possible, DU equals Fannie, LPA equals Freddie. Memorize this. It is tested constantly. The primary market is where loans are originated, the direct transaction between lenders and borrowers. MLOs work in the primary market. The secondary market is where already closed loans are bought and sold. Fannie Mae and Freddie Mac operate in the secondary market. They do not lend directly to borrowers. When an MLO closes a loan, the lender may sell it to Fannie or Freddie in the secondary market, replenishing the lender's capital to make new loans. Standard Fannie and Freddie underwriting guidelines: minimum credit score of 620, maximum back-end DTI of 45% standard, up to 50% with strong AUS approval and compensating factors. Maximum LTV of 97% for Home Ready and Home Possible, 3% down programs. PMI required when LTV exceeds 80%. Income limits apply to Home Ready and Home Possible. Income must be at or below 80% of area median income. PMI is required when LTV exceeds 80%, when the borrower puts less than 20% down. Two critical PMI thresholds under the Homeowners Protection Act. At 80% LTV, the borrower can request cancellation. At 78% LTV, PMI automatically cancels. Both thresholds are based on the original purchase price and original amortization schedule, not the current appraised value and not based on extra payments made. Borrowers who own 25% or more of a business are treated as self-employed for mortgage qualifying purposes. The threshold is exactly 25%, not majority, not 51%. A 24% owner is not self-employed under conforming guidelines. Self-employed borrowers must provide 2 years of personal tax returns, 2 years of business tax returns, and a year-to-date profit and loss statement. Income equals the 2-year average of net income from tax returns. When a borrower has rental property, only 75% of gross monthly rent can be used to offset the rental property's PITI payment. The 25% haircut accounts for vacancies, management costs, and maintenance. Example: gross rent, $2,000 per month, times 75% equals $1,500 usable income. If rental PITI is $1,700, the net loss of $200 counts as a monthly obligation, increasing the borrower's DTI. Key difference between PMI on conventional loans and MIP on FHA loans. PMI on conventional. Cancelable at 78% LTV under the Homeowners Protection Act. FHA MIP. If the original LTV was above 90%, annual MIP lasts for the life of the loan and cannot be canceled by request. To eliminate FHA MIP on most loans, the borrower must refinance into a conventional loan once they have sufficient equity. This is a significant long-term cost difference. Non-conforming loans exceed the conforming loan limit or fail to meet GSE underwriting standards, cannot be sold to Fannie Mae or Freddie Mac. Lenders hold them in portfolio or sell to private secondary market investors. Jumbo loan characteristics typically include minimum 720 credit score, 10 to 20% down, 12 or more months of reserves, stricter DTI requirements, and slightly higher interest rates than conforming. The lender bears full credit risk without GSE purchase. Conforming loans exam traps. Trap 1. The conforming limit applies to the loan amount, not the purchase price. Trap 2. DU equals Fannie Mae, LPA equals Freddie Mac. Do not mix them up. Trap 3. PMI request threshold is 80%. Automatic cancel is 78%. Two different events, two different numbers. Trap 4. FHA MIP with original LTV above 90% lasts the life of the loan. It does not cancel like PMI. Trap 5. Self-employed threshold is exactly 25%, not key numbers for conforming loans. 2024 standard limit, $766,550 for one unit. High cost limit, $1,149,825. Minimum credit score, 620. Maximum back-end DTI, 45% standard. PMI required, LTV above 80%. PMI request cancellation, 80% of original value. PMI automatic cancel, 78% of original value. Self-employed threshold, 25% ownership. Quick recap. Conforming loans must meet the loan amount limit and GSE underwriting standards. 2024 limit, $766,550 standard, $1,149,825 high cost. DU equals Fannie Mae, home ready, LPA equals Freddie Mac, home possible. Primary market, where loans originate. Secondary market, where Fannie and Freddie buy loans. PMI required above 80% LTV, request cancel at 80, automatic cancel at 78, both based on original value. That is video 7. In video 8, we cover advertising rules, TILA trigger terms, NMLS number requirements, UDAP standards, ARM advertising, and FHA and VA advertising rules. See you in video 8.